All right, there you go. Your closing bell on Wall Street for this Thursday. Let's check out how the markets closed. Up about 200 points on the Dow and some red the rest of the way. The S&P drops about 23 points and the NASDAQ continues to fall. Been a rough go thus far for big tech, falling 1.6%, a drop of 178 points. For a closer look at the markets, let's bring in James Liu, Clearnomics founder and CEO, and Michael Landsberg, Bennett Private Wealth Management Chief Investment Officer. Nice to see you both. Michael, we'll start with you. What are you learning in this market the last couple of days?
I think what we're seeing is earnings aren't particularly good. A lot of people are talking about beating expectations, but 180 stocks so far have reported roughly of 500 S&P. Earnings growth is negative 3% year over year. Even great names like McDonald's, they beat expectations, but in reality, they did $2.86 a year ago. They did $2.68 this quarter this year. It's deceleration in earnings. It's something that we got to keep an eye on.
James, what do you think? Here we are looking at a day where we're seeing a bit of mixed action. Dow holding on to gains. S&P still above 3,800, but ending the day in the red. I guess the moves that we've seen over the last couple of weeks since we last spoke, have they made sense to you? And what does that signal?
Yeah, well, Seana, basically you are seeing this divergence across sectors and across major indices. Obviously, tech is dragging things down right now as we speak. Those earnings are being hit hard. But when you look at overall earnings, those are coming down a bit because of the sluggish economy. But earnings estimates are still around $220 for full year guidance. Now, again, those will probably come down a bit. They're probably a bit too lofty. But even if they come down, and we're talking about 8% earnings growth, that's still actually quite strong. So it really depends on the specific sector and the overall market that we're looking at. But then it becomes a question about the Fed, and that's where today's GDP report was strong. So, basically, we're going to have to look very carefully at the earnings numbers over the next couple quarters to see if the earnings guidance that we're seeing right now does play out.
Yeah, and Michael, you mentioned your thoughts on earnings thus far. What does the GDP number up 2.6% tell you is coming?
I think it tells me the Fed, this idea of a pivot's not going to happen. Fed's been raising rates and the GDP, hasn't really gone down. It's been able to grow this quarter. We expected a little bit of growth this quarter. I think the kind of the heavy stuff happens fourth quarter and first quarter. But the idea of a pivot here, I think, is crazy to me. I think people are rallying the market thinking this is not going to happen. But I think the Fed to go up quite a few times. They'll be higher than many people want. And I think you need a position for that.
How aggressive, Michael, do you see the Fed potentially getting then?
I see at least the next three meetings, obviously November, December, and then obviously late January, February, just because I think what they're seeing now is it really hasn't hurt. I mean, unemployment's still very strong. GDP numbers here are strong. So I think their goal is, and Powell seems like a student of history. When I look back to the 80s, Volcker raised rates a lot to get it above, Fed funds were above CPI. And I don't know if we have to get there, but we certainly, I think, are in a spot where they're going to continue to raise. ECB raised 75 basis points this morning. I think it's basically full raises ahead. Again, I'm not saying I want that, but I'm looking at what's happening. I think that's what we're going to see.
James, your thoughts on the next three meetings continuing the Fed hikes?
We do think that the Fed is going to have to continue to hike, not just because that is the path they're on, but also because inflation not only hasn't come down, but it's gotten worse. And even if it does come down, it's going to take a while for it to get back to even anywhere close to the Fed's target. So, you look at today's GDP report and it's positive, but of course, good news is being interpreted as bad news in the market. But what the GDP report really tells us is that it is not inevitable or unavoidable to have a hard landing. It is possible theoretically to strike some sort of balance here. And really, that all that means is that the Fed is probably going to keep raising rates until we do see unemployment start to tick up, until we see growth start to slow a bit further. But it's also possible that many sectors still continue to outperform in that environment.
Michael, where are you seeing the most opportunity, just given all the volatility that we have been seeing? We're waiting for Intel, Amazon right now. Given the losses that we've already seen in the tech sector, is there an opportunity to buy there?
In tech, no. To me, it looks like tech is the area that will continue to be, again, had the best gains the last 3 years. It's going to suffer the worst here in an environment where there is some deceleration. Certainly seen it across the board with some of the ones that have already reported. I think you want to stay out of that space. I think you want to look at healthcare, things that do well in a recession. Healthcare, staples, and particularly like discount stores and utilities. I'm still a fan of the U.S. dollar. And I think that's the places you want to be. Again, at some point, there's some good tech companies, maybe one-offs, but as a sector, They've had great runs, and I think they're going to give a chunk of them back and continue to do that.
James, are we anywhere near a buying opportunity in big tech? And what are your expectations the rest of the way? We've still got the Apple and Amazon numbers coming out here any minute.
Yeah, so we generally would prefer the consumer sectors a bit more. Those sectors are challenging because obviously inflation is hurting consumers and the housing market is going to hurt households. However, you look at the earnings growth that we're seeing in those areas, and that's still a bright spot in this economy. And so although there's going to be challenging times in the consumer sector, that's really what we prefer. Tech, we would still be in a holding pattern here. There are just too many things playing out, especially very stock specific, non-macro activity that's happening that's affecting those stocks.
Okay, got to leave it there. Got some news coming in. James Liu, Michael Landsberg, thank you both. Appreciate that.